Most people want passive income because it means freedom. The ability to cover your expenses without relying on a job sounds life-changing, but what usually gets overlooked is the math behind it. How much do you actually need invested to earn $500 a month? How long does it take for dividends or rental income to grow into something meaningful? The numbers often surprise people, and that's why so many give up before they see results. In this video, we'll break down the math of passive income step by step, so you can see what it really takes, how it grows over time, and why the early stages matter more than you think. The first thing to understand is that passive income is almost always built from assets. Assets are things you own that produce cash flow, whether you're actively working or not. That could be dividend-paying stocks, rental properties, digital products, or a business that doesn't require your daily involvement. The key is that the money doesn't stop if you take a break. But the surprise is how much capital it takes to build meaningful passive income. Let's start with dividends as an example. If you invest $10,000 into a stock that pays a 4% annual dividend, that's $400 per year. That doesn't sound like much. It's not enough to change your life. And that's where many people get discouraged. But the math gets interesting when you keep adding to that base and allow compounding to do its work. If you consistently invest $500 a month into dividend-paying stocks at the same 4% yield, after 10 years, you'd have around $75,000 invested, producing about $3,000 a year in dividends. Still not life-changing, but now it's covering real bills. Extend that to 20 years and the portfolio could be over $200,000, producing $8,000 a year without touching the principal. That's the surprising part. It doesn't look powerful at the start, but the curve bends upward as time passes. Rental real estate shows similar math. Buying one rental property won't make you wealthy overnight. You might clear $200 or $300 a month in profit after expenses, but that's the starting point. Add a second property, then a third, and suddenly the math changes. Over 10 to 15 years, as rents increase and mortgages are paid down, the cash flow grows. What seemed like small amounts in the beginning stack into meaningful income streams. The math feels slow at first, but it becomes exponential when you zoom out. Another important piece is reinvestment. When you take the income your assets produce and reinvest it, the snowball effect kicks in. Back to the dividend example. If you reinvest those $3,000 a year instead of spending them, they start earning dividends too. That extra layer of compounding speeds up the growth. Many people underestimate how powerful this is because the numbers feel small at first. But over decades, it creates a self-sustaining machine. This is why patience is such a big part of building passive income. Most people quit before the results show up. They look at the first few years and think it isn't working. But those early years are just the foundation. The real growth happens later. It's like planting a tree. The first years are slow and you barely notice the change. But once the roots are strong, the tree starts growing faster and providing shade that keeps expanding. The math also explains why the wealthy put such a high priority on owning assets. If your entire income comes from a job, it stops the moment you stop working. But with assets, the money keeps coming in. The earlier you start, the less money you actually need to contribute out of pocket because time does more of the work for you. For example, someone who starts investing $500 a month at age 25 could have over $500,000 by 55. But someone who waits until 35 to start would need to invest more than double each month to end up in the same place. The math favors the early starter, even if they start small. Another surprising part of the passive income equation is the idea of replacement income. Many people think they need millions to live off passive income, but the real target depends on your expenses. If your lifestyle requires $10,000 a month, you'll need a very large portfolio to cover that. But if you keep your lifestyle at $4,000 a month, you only need half as much. This is why controlling lifestyle creep is just as important as building income streams. Every dollar you don't spend is a dollar you don't have to replace with passive income. There's also a psychological hurdle. People are trained to think in terms of salaries. If you make $60,000 a year, that feels normal because it comes in regularly. But if you build a portfolio that pays you $500 a month in dividends, you might dismiss it as too small. Yet, if someone offered you a part-time job paying $500 a month with no hours required, you'd take it. Passive income works like that. It's a silent paycheck that doesn't require your time. The math feels small at first, but it's still income that compounds. Another example comes from digital products or online businesses. Let's say you create an ebook or an online course. At first, you might only sell a few copies and make $50 in a month. That doesn't feel like much. But if you improve it, add marketing and scale it, those $50 months can grow into $500 or $5,000 months. The math is about building systems where the effort happens once, but the income repeats. This is another form of compounding that people underestimate until they experience it. The real surprise is how multiple streams of passive income add up. Dividends alone might not replace your income quickly. A single rental property won't either. A digital product may only make a few $100s, but when you combine them, $8,000 a year in dividends, $6,000 a year from rentals, $5,000 a year from digital products, suddenly you're at $19,000 a year in passive income. Layer on more assets over time, and you start replacing a salary piece by piece. The math of combining streams is often what unlocks financial freedom, not just relying on one source. There's also the math of risk to consider. Building passive income doesn't mean chasing the highest return. In fact, the higher the promised return, the higher the risk of losing money. Millionaires understand this well. They don't aim for unrealistic numbers. Instead, they stick to steady, repeatable returns that add up over time. The math rewards discipline far more than excitement. Another important point is that passive income doesn't mean no effort. The passive part often comes only after an upfront investment of time, money, or both. Buying and managing rental property takes work at the beginning. Building a digital product takes hours up front. Even investing requires research and discipline. The math works in your favor, but only if you put in the effort to set it up. Once it's running, the effort decreases, but the income continues. That's the part people misunderstand. The most surprising thing about passive income math is how ordinary it looks at first. It doesn't feel impressive in the beginning. It feels slow and almost pointless, but if you stick with it, the numbers begin to accelerate. And eventually, you hit a point where the income is significant. That's the tipping point most people never reach because they gave up too early. So, what's the takeaway? Building passive income is less about big wins and more about steady accumulation. The math rewards patience, consistency, and discipline. Whether it's dividends, rentals, or digital assets, the principle is the same. Build slowly, reinvest, and let time magnify your results. The person who looks for shortcuts will always think passive income doesn't work because the early years don't deliver instant results. But the person who understands the math, starts small, and stays consistent will eventually realize that passive income isn't just a dream. It's a reality that compounds quietly in the background. So, what's the takeaway? Building passive income is less about big wins and more about steady accumulation. The math rewards patience, consistency, and discipline. Whether it's dividends, rentals, or digital assets, the principle is the same. Build slowly, reinvest, and let time magnify your results. The person who looks for shortcuts will always think passive income doesn't work because the early years don't deliver instant results. But the person who understands the math, starts small, and stays consistent will eventually realize that passive income isn't just a dream. It's a reality that compounds quietly in the background.